Good afternoon. This is Galen Longo from Group 4. Our group consists of Chandler Ryan, Zachary Cagle, Jake Neely, and myself. Today we will be reviewing a case study on initial public offering, or IPO, for Google as it was in 2004. Through research and exploration of the two types of IPOs, we can clearly see why the company should go public and choose W.R. Hambrick's open IPO auction rather than the traditional book building method by examining the potential risks of underpricing and excess flipping that could affect the stock's long-term performance.
Throughout this presentation, we're going to go over some key facts. For the case overview, we'll be looking at the introduction, what happened to Google in 2024, the advantages and disadvantages of an IPO, what challenges come with price stabilization and underpricing, auction IPOs and book building IPOs, and the disadvantages and advantages that are associated with them, and IPO methodology and who benefits from it. Lastly, we'll have Google IPO and the conclusion we've come up with. Throughout this case, we have noticed that Google wants to become a larger company, and through the IPO process, Google will have the opportunity to transition from a private to a public company. And based on what we uncovered, the research of book building and auction IPO methods, Google should go with W.R. Hambrick's open IPO auction method rather than the traditional book building method. Also, by going through the open IPO auction, Google will have the chance to set the tone for the company's IPO, essentially laying the foundation for how the company will operate as a leader in the industry for the many years to come. Why does Google want to go public? Well, in 2004, Google was the most talked about company since Netscape in the spring of 2004. We also see that they are profitable in 2001, and in 2003, they had revenues up into the 9 millions. We also see that there's a growing competition between Yahoo and eBay, and Google wants to compete with them as well. And right behind them is Microsoft trying to enter into the market. Google also has a unique technology patents that expire in 2011. They also need to find the best way to attract an investor to invest in the company. On this slide, we're going to be looking at the W.R. Hambrick's mixed results for open IPOs and book building IPOs. On the left, you see the open IPO, and if we look at the Andover.net company, it does really well on the first day, but then drops at 180 days. On the right side, we see that it does well the first day, does really well in the first week, but then drops dramatically after 180 days. This just shows us that there are mixed results for both.
Now we're going to talk about some of the advantages for Google to go IPO. Number one, they would have increased liquidity. They would have access to capital to grow the business faster than it would relying on internal funding from their current growth projections and business planning. Number two, it creates publicity and brand awareness for a company that was taking off at the time. Number three, it encourages diversification so that Google can reduce risk, potentially leading to the long-term growth to support the company goals that they hope to achieve. While the advantages of Google going forth with their IPO seem like a safe bet, we must examine the potential disadvantages in order to get a clearer understanding of what that looks like. Now let's consider the market in 2004. Market conditions weren't that great. They're on the weaker side, still reeling from the after effects of the dot-com bubble bursting in 2002. Their industry alone pose a risk based on recent track records from other internet companies of the early 2000s. While they would raise capital with their IPO, the trade-off would be a diluted ownership, with some of the control of the company shifting to shareholders. Pressure from shareholder expectations could in turn force management to focus on short run performance instead of long term growth in order to meet the expected earnings goals of their investors.
When evaluating a company for an IPO, it is important for an investment bank and underwriter to reduce the underpricing effect in the best interest of the issuer. Underpricing is when the offering IPO price is set lower than its market value after the trading begins. This means that the company raises less capital than it could have if shares were priced accurately. This benefits the investors as they can turn around and sell for a quick profit, and it is not desirable for the issuing company. The underwriters use their access to investors in an attempt to mitigate underpricing. This is outlined in Paul A. Spendent's How Investment Bankers Determine the Offer Price and Allocation of New Issues. The passage explores how investment bankers use indications of interest from investors to price and allocate IPOs. All this considering factors such as the asymmetric information friction, auction dynamics, and underwriting contracts. The author explains a type of pre-market auction model. The model presented involves a private firm offering a fraction of its future cash flows, with investors possessing different pieces of information. The auction occurs in two stages, and it's designed to encourage investors to disclose their information to the underwriter. And it is because of this the investor and underwriter relationship creates a sort of asymmetric line of information. This is further exaggerated by information frictions. Importance of price stabilization in the market. Stabilization plays a critical role in maintaining the efficiency of the financial markets and broader economy. Price stabilization gives the markets confidence, which fosters a confidence amongst investors and market participants. They have to have confidence in what they're investing in to keep the money cycle continuing and for them to keep investing. Next is risk management. This makes it predictable for price. Predictable prices make it easier for investors to assess the risks associated with their investments. Any good company has a good risk management protocol, and this aims to protect an organization from potential losses or threats to its continued operation. And lastly, an important reason that price stabilization is so vital for the market is fairness. When the prices are stable, market participants are less likely to be subject to manipulation or unfair practices that can distort it. And when the prices are stable, everyone is better off. Price stability supports economic growth and employment. It allows people to make more reliable plans when taking decisions about borrowing, saving, and expanding businesses.
Hello, my name is Chandler Ryan, and I will be going over both the auction and book building methods along with their advantages and disadvantages. One option Google could pursue in their IPO process is called the auction method. This method is more direct and democratic approach because the company itself collects offers from all interested parties, both institutional investors and the general public. These offers of shares willing to buy and price willing to pay are collected over a specified period of time. This is intrinsically more transparent and usually leads to a better reflection of real market demand for the security. During the allocation process, the company aims to sell all its available shares at or below the average investor's asking price. In using this method, the company can prevent preferential treatment of the high net worth and major fund investors. Finally, in using the auction method, the company has much more control and influence over their entire IPO process. However, in doing this, the company takes on risk in the form of volatile fluctuations in their stock price due to overbidding or lack of investor participation. The auction process is generally more complex for both the company going public and the investors themselves. It requires investors to understand and participate in the bidding process, which can be a new challenge for retail investors. This complexity can lead to uncertainty about the final outcome, including the final price and the allocation of shares. Institutional investors may be less interested in participating in auction IPOs as well. These investors are accustomed to the book building method, where they often get preferential treatment. In an auction, their bids are treated the same as those from smaller investors, which can be less appealing. Traditional book building IPOs are typically accompanied with extensive marketing and roadshows that generate awareness and interest among potential investors. The auction method might lack this level of visibility, and potentially that'll impact investor interest. Because of these risks, the auction method is less commonly used compared to the book building method, which I will talk about next. Another option Google could pursue in their IPO process is called the book building method, which was most prevalent at the time. In this traditional method, underwriting firms or investment banks determine the price of the IPO by gauging investor interest. They do this by collecting bids from institutional investors, like mutual funds and pension funds, during a pre IPO roadshow. This roadshow consists of a series of presentations by the company's management across many locations to attract as many investors as possible. In doing this, only high net worth individuals and funds have access, excluding the general public, to the IPO shares in the beginning. Based on the fact, Based on the feedback, rather, from roadshows, underwriting firms can better understand how many shares and at what price investors are willing to buy at. Once a price is set, the underwriter now allocates shares to investors, which again typically favors the high net worth and major fund clients. During the roadshow, the company's management has the opportunity to engage directly with large investors, tell their stories, and build confidence in the company itself. This engagement can be crucial for the long term success of the stock. The method can also lead to less volatility in the initial trading days post IPO, as the price has been set through and through market assessment process. Book building allows underwriters to manage the risk associated with the IPO by addressing investor interest beforehand, they can adjust the pricing and size of the offering accordingly, reducing the likelihood of the IPO failing. Because it's more traditional and widely used method, book building is well understood by market participants, which can ease the process for the company going public. One potential risk in this process is the set IPO price may not reflect the true market demand for the stock, which can under or overvalue the company. Moreover, underwriters often underprice the security, ensuring they profit off the initial uptrend of the IPO, which does not directly benefit the company. The book building method often favors institutional investors like large banks or hedge funds, and they are usually given priority in share allocation, potentially at the expense of individual or smaller investors. And this can lead to an uneven playing field and can be seen as less democratic. The process can be less transparent, with the pricing and allocation decisions largely influenced by underwriters. The actual demand for the market might not be fully reflected in the pricing, and smaller investors often do not have insight into these decisions. The involvement of investment banks as underwriters in the book building process can lead to significant fees and costs for the company going public, and these costs can be substantial and reduce the net proceeds from the IPO. As we can see, the underwriting firm has a significant amount of control and influence both in the pricing of the IPO and in the allocation of shares.
Let's talk about IPO methodology briefly. Who benefits? Well, issuers, underwriters, and large institutions are going to be the ones that benefit most from the book building method because the level of control and the means of which they have to guarantee themselves a profit. Whereas retail and smaller investors are going to benefit more from the auction method because of the type of approach and the way that they can submit offers of all sizes over a specific time period. Through review of Google's IPO filing process as well as their actions as a private company, it was clear that they certainly had ambitions to be unconventional. At the time, Google was a strong brand, had a very highly anticipated IPO, and an even higher level of investor interest. Since Google aimed to be inclusive to all investors and valued both their independence and control within its company, their choice to use W.R. Hambrick's open IPO auction method rather than the traditional book building route would be justified. Thank you.